The economy is technically no longer in a recession. It is definitely not in a depression, a fact that a year and a half ago you might have won a bet or two by predicting. The economy is actually growing again, and while the jobs numbers still stink, the more economic growth we get, the better chance we'll have of escaping the gaping, horrible maw of the financial meltdown in 2008, the meltdown that almost killed the economy altogether. While an increasing number of people will credit moves taken by the Obama administration and his Treasury Secretary in particular for saving the economy, A, there's still a long way to go, and B, there's still the very awkward fact that Secretary Geithner was in the middle of the financial meltdown when it happened, as president of the New York Fed. In our interview today, Mr. Geithner made a frank appraisal. What's his fault? What's the system's fault? And why you have every right to be stomping mad. From 2003 to 2008, you were the head of the New York Fed. And that was a time on Wall Street of untrammeled, defying common sense, both risk-taking and deceit that almost destroyed the American economy. And I think some credit due to you and the administration for saving the economy and having that not happen, having this not be a Great Depression. But where were you when it was happening in the first place? What do you wish you had done differently?
Excellent question. It's important to start with the basic mistake, and it's like in consumer protection. Okay? What we did as a country, and it was a tragic failure of government, is we left vast swaths of the financial system with no oversight. Okay? So pick your example. Fannie Freddie, the major investment banks, Lehman Brothers, Bear Stearns, Countrywide, IndyMac. You can take AIG, any example you want. You can take derivatives, any example you want. And we left vast swaths of the financial system without anybody in charge and accountable for overseeing those things. Now, the Fed had a very important responsibility as the supervisor of the nation's largest banks. And the Fed did a very good job, at the New York Fed, we did a very good job of trying to move early to bring a little bit of order to derivatives markets, to try to make sure that we were inducing these firms, the biggest firms across the world, to try to make sure they were building stronger capital cushions against risk. But we did not do enough. I'm the first to admit, and I know a lot about what our mistakes was in there. I would be the first to admit we could have done a better job in this case. We were very aggressive in New York. We made a lot of difference in New York, but we could have gone further. But the big mistake we made as a country was to allow a system to develop where you could get around those rules, build up a huge business with a huge amount of leverage, with no oversight, no transparency, and that's what brought the system to the edge of its knees. If we hadn't made that mistake, that huge mistake, not moved earlier to put in place these kind of sweeping reforms across the system, this would have been a much more manageable crisis, much less damaging to the American people. So you're right to focus on the Fed, but the Fed was the strongest, the best, most able of those regulators in the United States and around the world. And the mistake the country made was not provide broader authority to constrain risk-taking across the entire system. If you only do it on one part of the system, you know, what happens is the risk and the bad stuff just moves.
Right.
It just moves, and that's what happened over time.
More lawless neighborhoods.
Yeah. So you had a whole parallel banking system merge outside banks, almost as large as what was done in banks, funded in a very vulnerable way, very vulnerable to runs, with none of the protections and constraints we built after the Great Depression to constrain that kind of risk-taking. That was the big mistake we made. That was not the Fed's mistake.
That doesn't mean that there will never be another too big to fail again. It doesn't have as its central core the so-called Volcker rule, Paul Volcker, where basically you have a limit on what these banks can do, what they can have, what they can trade. This doesn't really cover any of that. Plus, the so-called Consumer Protection Agency that's in it is going to be housed at the Fed.
Yeah. You'll know where to find it.
Okay.
You know exactly where to go.
And the Fed will have, they'll have one of the board members will be someone from the Fed. I mean, come on. What part of this doesn't Dodd and some of the Democrats, what don't they get? The American people want this fixed. We lost billions of dollars. They brought down the economy of this country. The question, you know, and he said today, he says, well, we don't want to punish Wall Street. Yes, we do. Yes, it's exactly what we need to do, because if we don't do it, they won't do anything to change. I mean, unless there's a stick that says, look, if you steal money from the American people, if you lose the pension money of the workers of this country, you're going to have a price to pay for this. Instead, what we did was we wrote them more checks and said, here, thanks for stealing the money, take some more. I mean, it's absolutely the wrong message to send to a thief. And
the notion, the principle, if we can call it a principle, of too big to fail
was never written into U.S. law anywhere. That was just the collective judgment of the wise men in Washington as these failures started to crop up on Wall Street, and they just looked at it and said, that one's too big to fail, that one isn't. Right. I mean, so if the Congress wants to say to us today, too big to fail won't happen again because, we're not writing it into law, well, it was never written into law.
Right.
What's to prevent that from happening again?
Listen, here's the bottom line. There were no bank disasters, not one, between World War II and the 1980s. And as soon as Ronald Reagan went in there and the Republicans and Reagan took away the regulations, started chipping away at them, we had the savings and loans crisis at the end of the 80s. We had the hedge fund meltdown in the late 90s. And now we've had the crash of 08. And when Dodd says, this isn't to say that there won't be other disasters, it wasn't his word, but other problems in the future, he's admitting that this could very well happen again on some level. And that this doesn't really, I agree with Paul Krugman, what he said in the New York Times a couple weeks ago, that it might be better actually not to pass this bill than to pass a bill that gives all of us the sense of, oh, it's all okay now, we're all safe. That to create that kind of delusion may do more harm and may not do what we need to do, which is to prevent the next crash from occurring, which is going to occur because they're back to dealing with derivatives and credit default swaps and all the crazy gambling that they were doing before. They're still doing it and giving themselves huge bonuses with our tax dollars. It's I was thinking earlier today, Senator Dodd, I mean, he's not ready for re-election. He could go out with repairing his legacy, go out in blazing colors on the side of the people. If he would actually produce something. Now, the White House has said they're going to try and strengthen the bill. I hope that happens. It'll only happen though people make their voices.
But it was that mistake that brought the system to the edge of collapse. Because in those, what happened was we faced, just the modern version of a classic run in a financial system. People were not just starting to take the money out of banks, but they withdrew the money as quick as they could from all those other entities. They came down just with forceful, brutal pressure on the rest of the system. And the government didn't move early enough to try to contain that damage. But that's what we're trying to fix in reform. We're trying to make sure we have as much authority to contain that kind of risk-taking more broadly early.
Of how much authority you have, though, is where I get hung up and why I'm still concerned about the Fed now, why I'm still concerned about your record at the Fed, and frankly. I'm happy you can go back and look at my record. I can tell you with a lot of knowledge, of course, the stuff we were right on early, the stuff where we made a lot of difference early, but I can also tell you, and I know a lot about this, where the Fed was behind the curve and late, and the best example of that was the Fed did not use its authority to write rules to provide better protection for consumers, like in mortgages early. The chairman of the Fed has said that openly. I agree with that. That's why we propose to take that authority away from the Fed and to give it to an agency where the people wake up every day and they think about one thing, which is a very good job of running a very well-managed program that is in the interest of the average American, not just because they care about the cost of credit, but because, again, we faced a lot of challenges as a country, and we didn't want to see their resources used unnecessarily to benefit a bunch of big banks. I understand how mad people are to see the loans not being made and the bonuses being paid.
People are incredibly angry, and they should be angry still, because, again, we had a terrible failure of government and judgment in the financial system that caused catastrophic damage to a people who were totally responsible, didn't borrow beyond their means, were careful in their basic judgment, and they're suffering because of the mistakes of a bunch of other people made, and people should be angry. And we hope that anger turns into more political will in the Congress, frankly, to legislate a tough set of reforms. And the President's proposed that we put a $90 billion fee on banks over 10 years so that we can say to the American people that they won't be exposed to a penny of loss from all the terrible things we had to do to step in to rescue this financial system that was burning. So, of course, they're angry. They should be angry about it, and they have a right to be angry, and they should be angry until they have more confidence that the government's actually going to put in place reforms that'll fix what was broken, and they see more traction in all the things we're doing to help bring growth back, bring
60-vote problem. He has to get anything to pass, he's got to get over the 60-vote hurdle in the Senate, which is why he's been trying to negotiate with Republicans. How can he get there from where he's standing now?
And that's the way you would look at it as an insider. Right. Okay, now speaking.
That's the hack speaking.
No. Now the citizens.
Citizen.
What the citizens have to do is people of Maine and Connecticut. These are the three votes. These people need to do what's right for the American people, and so there needs to be huge citizen pressure on the two senators in Maine, the rogue senator in Connecticut, and that's how we're going to have that. But again, we're back playing their ball game by their rules, talking about 60 votes. It's 50 plus the Vice President of the United States is 51. We only need 50. That's all we need. I'm sure they have that. And if they want to filibuster, you know what? Let them filibuster. Call their bluff. Make them stand there for 24 days, reading from the phone book or doing whatever, standing up to support the banks and Wall Street and the people that stole the money from the American people. Let them, I want to see that. Please, let them filibuster for 24 days.
Sadly.
They won't get through 24 hours before those switchboards will light up and the American people will say, that's the end of that.